Good morning, good morning, good morning. My name is Don Daniel, founder of Pill Method International, a better way to eliminate debt. And today we're going to be talking about the chains that bind you, the chains that bind you. If you want to understand why people who are very smart, they're still in debt, they're doing everything they know to do. We're going to go over several things people are practicing right now: refinancing, they're practicing biweekly payments, they're practicing rounding up the payments. They're doing everything they know, but they're still in debt for a very, very long time. We're going to talk about how you can get out of debt in an average of 7 to 9 years today without doing all of those other things. The idea is interest cancellation, ladies and gentlemen, and we're going to get started here in just a second. So I need you to buckle your seatbelts, all right, and get ready for a fantastic show. Are you ready? Let's go. Hello, 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 everybody. Don Daniel here, founder of Pill Method International. The PILL stands for prepayment of principal, isolating the principal amount, leverage, and liquidity. And today's show, we're going to put that graphic back on the screen here. Today's show is the chains that bind you. If you have a mortgage and you're trying to do a 15-year mortgage to save money, if you're trying to do the snowball to pay off the debt, you're trying to do biweekly payments to get out of there, you're trying to do large down payments, refinancing down to a lower interest rate, all of those things are links in a chain that keep you in debt longer than you want to be. And I'm going to show you the numbers today. All right. So, but somebody had a question for me right off the bat. So who was that had a question for me?
I did. This is Byron.
Go right ahead, Byron.
So my question for you is, how do you get like debt that's paid off?
Okay.
Your credit report. I mean, I have okay credit, 685,
Yep.
694, and 720. And there's these three old credit cards I paid off that won't come off my credit report. And I have two inquiries. And I don't know how to get this off my credit so I can have a even 700 credit score.
Okay. So have you talked to a credit expert on how to get that off?
I've talked to certain people and they want like thousands of dollars to get three things off.
All right, here. I know a guy that unless you don't pay him unless he's actually performed what he said he can do.
No way.
Yes. Because you know what? The law says if you're in this type of business, that's the way you have to do business. You have to perform first and then charge. Yeah, they put it in a contract. Okay. So if people try to get the service and not pay, now they can be held legally liable for the payment. But the way that this is supposed to work is you're not supposed to pay for anything that has to do with debt or fixing credit without doing the work first and then you pay. How would you like that?
Man, I would love that.
Okay, DM me on my if you DM me or go to ice10k.com and contact me that way. But if you DM me on the Pill Method on my Instagram, all right, and I can give you that information. Okay.
I'm gonna do it. I'm doing it right now as we speak.
All right. And he'll be glad to help you. All right.
I appreciate you so much, man.
Listen, not a problem. Anybody else have a question before we get started? Come on up. I see you, Matt. Come on up here. All right. Let's invite Matt to speak. All right. Come on up. All right, Matt, how are you doing?
Good. Good morning. Good morning. How are you?
Doing fine, sir.
Good. Good.
What?
Sorry. Go ahead.
No, I was just going to say, what's on your mind today?
Yeah, I was just looking at some credit improvement options. Is that something we could work with here as well?
Listen, let's. If it has to do with debt, if it has to do with credit, we're an open forum here. I have a show to do,
Okay.
but if I got questions, I
Oh.
love it when I get questions. It just drives the show.
Yeah. So my question is the indications that dictate your credit score. Is there anything that could be done outside of those indications to improve it?
Okay, so first of all, let's find out what the goal of the goal is. So, is there a reason why you want your credit score improved?
Absolutely. So lower rates, right? That's primarily the number one
Okay.
reason. The second reason is lending limits, but primarily lower rates.
Okay, so Matt, would you getting a credit score or a credit profile? And the credit profile is more important than credit score. That's number one. What types of credit that you have and the length of time you've had that credit, and is your name correct on your credit profile? Are the address correct, or do they have more than one name on there? Do you have your name on your credit profile as your first, your middle, and your last name? And is there also a first and last name without a middle name, or is there a first and last name with a middle initial? If all of those things are on your credit profile, you need to condense that down to one name, one address. That will go a long way in helping your credit profile. Okay. The other thing that you want to do is make sure if you can get a credit card, a mortgage, a car loan, if you can have several different types of credit, that helps you as well. But here is something that will probably surprise you. Get the credit score that's going to allow you to apply for credit and get it. But I'm here to tell you, and I'm going to prove that today. The higher the interest rate, okay, you're going to actually save more money in interest and pay off the debt faster at higher interest rates than you can at lower ones.
Is that assuming you don't incur any interest?
Oh no,
pay it off in full?
No. So I can. Are you in a position to go use a different device and watch this on YouTube or something?
Not at the moment, but
Okay.
absolutely.
So you can watch it. You can
15 minutes or so.
Yeah, you can watch it later. Also, but that's one of the things that I'm going to go over today is everybody is doing what they can to get the lowest interest rate. Now, if I'm going to pay all the payments, let's say I have a 5-year loan. All right. If I'm going to make all 60 payments, I definitely want the lowest interest rate I can get. Or if I'm going to get a mortgage and keep it for 360 months or 30 years, okay, I want to get the lowest interest rate I can if I'm going to keep the loan for the whole 30 years. But most of my clients pay off their mortgages in about 7 years. So actually the higher interest rates actually work better in paying the loan off cheaper and faster. And I can actually start with that example today. Okay. What do you say, Matt?
Yeah, I guess I'm happy to listen and enjoy the show. I was just going back to the original question,
Sure.
the indications on that drive credit
Mm-hmm.
scores, right? That the big, I don't know, I call them like the big five or the big six, right?
Okay.
Utilization percentage,
Right.
right, number of open lines,
Yep.
right, history,
Mm-hmm.
right, zero, low number of or lack thereof of derogatory remarks,
Right.
right, et cetera, et cetera.
Yeah.
So
All those things are important.
yeah.
Okay. But
So
when I deal with my clients, I ask them, why do you want that? Okay. Because if the credit profile is correct, a person with a
Yep.
600 credit score can get approved, and a person with an 800 credit score will get denied if their profile isn't correct. And so some of the things that you're talking about add to the profile.
Well, how could you get denied if you actually have the score, though?
Oh, listen, because the profile is off, depending on what type of credit you have. Okay.
Yeah, but the profile is going to be linked to the number, right?
No,
So, like,
not
if you got a
necessarily.
600,
Not
it's a
necessarily.
catch-22. If they see that you got a 600, it's got to be tied to something, right?
Well, here's what I'm saying is that you don't necessarily have to have anything bad on your credit profile, on your credit score to have a 600. You could just be getting started. I had a college student that wanted to get their
Right.
Okay, so I said, get a credit card, or and if you can't get an unsecured credit card, get a secured credit card. So starting out, they can have a 600 or 650 and get approved for something else, because we're going to have their credit profile set up correctly from the beginning. There's nothing in there that says, okay, there's 3 names in here for you. So when you apply for a credit card or credit, you want to be electronically approved. And if the credit profile is up to snuff, you can get electronically. The computers will approve you. If they see too many discrepancies, then it kicks it out of the computer, and now human eyes have to see it. Now they have to go through and find out, why are these discrepancies on here? They're not necessarily negative. It's just that you have 2 or 3 addresses. So we got 5 phone numbers for you. We got 3 names for you. Okay. So which one is it? Those kinds of things. That's kind of what I'm talking about. But if your main purpose is to if I can get approved for a loan, but because of my credit score, they want to give me a higher interest rate, I don't care. I really don't. I never care about interest rate.
Well, if you're gonna pay it off in full, then the interest rate doesn't matter.
No, not paying off in full. I'm talking about paying it off cheaper and faster. You see, you are in control of how much interest you pay on a loan. So if one of my clients is supposed to pay $100,000 in interest, but they end up paying it off such that they only pay $25,000 in interest, they just saved 75 grand they didn't have to pay. Okay. So
you said it was 100,000 in interest.
Yeah, 100,000 in interest, but they end up paying 25. So that's called interest cancellation. You can cancel interest on a loan very easily if you know what to do. And these are the things that we talk about: is borrow money at a discount. Don't pay retail for your money. Borrow money at a discount. Now, what puts you in a position to better be able to do that? So banking traditionally,
a higher credit score.
Yeah, well, not this, just that, but banking traditionally wants us to do things so that we think we are following the rules. We think we're doing the best that we possibly can, when in fact we're doing something that's actually hurting us. Can I give you a quick example?
Sure.
Okay.
Please.
So I'm putting on
Knowledge is power.
All right, I'm going to put on the screen, all right, an amortization schedule, and This example I really had just not too long ago. All right. So $400,000 mortgage, and at the time it was at 3%. Okay. All right. And this guy said, I have an extra $100,000. Okay. An extra $100,000 that he wanted to use as a down payment. So he asked me if I should I put $100,000 down on this loan and have a $300,000 mortgage for 30 years, or should I just keep my $100,000? I told him, you want the $400,000 loan, not the $300,000 loan. Okay. But he showed me I have a lower payment. The amount of interest that the bank wants is lower. So I'm going to compare the two loans here. All right. That's part of what we need to go over today. One of the things that people are taught to do is put a large down payment on a loan. If you want to save money, put a large down payment on a loan. All right. So we're going to compare these two loans. This is the first myth we're going to bust today. All right. So we have 400,000 here, and we're going to change this one to 300,000. All right. And then we're going to take a look at the payment. And this is what he told me, because he's an engineer. So if I have a $400,000 loan, my principal and interest payment is $1,686.42. If I have the $300,000 loan, it's $1,264.81. Look at that, Don. It's like $300 cheaper. Okay. Oh no, almost $400 cheaper just to put $100,000 down. I said, you're right about that. So then he looked at, well, how much interest does the bank want on this over 30 years? They want $207,111 on the $400,000 loan, but on the $300,000 loan, they just want $155,000. Ooh, 207,000, 155,000. Okay, so now I told him this: if you get the $400,000 loan, and I'm asking you, Matt, if he gets the $400,000 loan and closes on that, where is his $100,000?
In his pocket.
In his pocket. So if he wanted to put it on the debt so bad, could he add it to his first payment?
Yeah, but that's the same thing as why not just put it down?
It is not the same thing, because if
the interest rate is the same, if the interest rate for both loans are the same, it's the same.
No, actually, it is not. You know why? Because he's going to save about $50,000 over a 30-year period if he uses it as a down payment, and he's starting out on payment number one for $300,000, isn't he? On a 30-year loan, correct?
No, the math is this. As long as the
do you want to hear this or not?
I'm just telling you.
Okay,
as long as
I can help you, Matt. I've been doing this 19 years. Let me help you. And if you can answer my questions, I can get to my point faster. And then after I'm done, you can question it. How's that? Okay. Okay. So if he has a $300,000 loan for 30 years, he starts out on payment number one on the $300,000 loan. Would that be correct?
Yeah. What's the interest rate?
3% on both loans.
Okay.
Okay. So now, if he has a $400,000 loan, all right, and he puts it as a prepayment, okay, he knocks off on his amortization schedule. He goes all the way down to line 125 on his amortization schedule. He just saved $110,000 in interest he'll never have to pay, and he did it in the first month. And he still has a $300,000 loan. But he's not starting out on payment number one. He's starting out on payment number 126 on his amortization schedule. A lot different?
No.
No? Why is that?
Yeah, because what's the interest on the remaining?
Well, here's the interest on
What's the interest on the remaining?
the interest on the remaining is if he saves $110,000, okay. So we started out at on the 400,000, he started out at $207,011. Okay. 207,000. I'm going to put the calculator on the screen so you can see this later. But you're asking a very good question. Okay. So he started out where he had to pay the bank $207,111. Okay. But by putting the $100,000 as a prepayment instead of a down payment, he just knocked off $110,000 worth of that interest. Okay. Because he did it in 1 month because he put it straight to principal. Okay. So we're going to go down to where we see $100,000. All right. And 110,226. So we're going to subtract how much interest he just saved. Okay. $110,226.84.
Yeah, but the interest off that loan comes off
Okay.
the last $100,000.
No, not if you understand how to read an amortization schedule. But the interest is front loaded. Okay, and I can go over that in a minute. He only has nine. He only has.
Interest.
Okay,
The interest
you
is
asked me a question. I'm
front-loaded.
trying to give you the answer.
Well, no, I'm just trying to have a conversation.
I understand, but you asked me a question. Let me finish the answer.
Because he won't have those payments. The interest is tied to the actual payment on the schedule.
Exactly. So if
but you don't start at day number like 129. You still start at day one. You just end early.
So I'm not saying day 129. I said payment number 129.
Whatever. Say that's my point. You don't start at payment 129.
Yeah,
You still start at payment one, and the interest comes off the.
Are you looking at the screen? Are you looking at the screen? Because people
right now live at the screen.
All right. So people are saying, listen, if you paid this loan down by $100,000, okay, how many payments would it take if you started out on payment number one? How many payments would it take? It would take 125 payments, wouldn't it?
It would, and you don't pay all 125, but the scale starts still at payment one,
right,
and completes until you have no more payments left because you took $100,000 in principal off of the loan.
So now you're 125 payments less instantly. I don't have to do this for 10 years to get 120 payments. I just did it in 1 month. I took over 10 years off in 1 month.
But this is no different than a $300,000 loan.
No, it isn't, sir. Because if you start out on a $300,000 loan,
it's not. That's my point.
If you start out of a $300,000 loan, you start on payment number one, and now you start making your payments.
And what is the total interest?
And I just tried to answer that for you, but you won't listen. Okay. Now the interest that he has left to pay, if he does it this way, is only $96,884. If he does a $300,000 loan your way, the total interest is $155,000.
No, you're taking the interest off the front of the loan.
Well, that's the way it's supposed to be, sir.
I don't know whether we could argue left or right or scream from the top of the Empire State Building what it's supposed to be.
Mm-hmm.
But I'm telling you that no loan of that amount in the contract terms of the loan is going to work that way.
All of them work that way.
Okay.
Do you know where it's not taught at any level of financial education?
It doesn't work that way because the contract terms of the loan don't work that way.
Yeah, it works exactly that way. And when you
absolutely a residential 30, 15, 10, 5-year mortgage don't work that way.
It works exactly that way. You know why?
Can you point to the language in a standard contract?
Sure.
Standard.
Sure. I'll be glad to point. So, do you want to know the answer? Or are you going to talk over me?
No, I want to know where that contract.
Okay. So, all right. Let me show you where that is. Okay.
Why don't we pull up a standard like bank?
No, I'm just going to show you what you asked for, sir. Contract. If you stop talking, I'll show you what you asked for.
Okay. Why don't we
Okay.
look at a standard sample contract? They're all
Thank you.
readily available.
Thank you. So,
You're welcome.
so if you go to um, you can Google this. Okay, it's just easier to find if you Google it. All right, and let me see here. Let me pull this up. All right, and there we go. Where is it? There we go. All right. Close this. All right, so I'm putting this on the screen. What we can do here. All right. Now, it's called the borrower's right to prepay, and you can Google it. And it's in every standard mortgage contract. Okay. And let me put this on the screen for everybody. All right. And we just need to share this screen. All right, so we're going to share a new screen here, remove this, and add a new screen. Image, share screen, and add a new screen. Entire screen, and we want this one. Share. All right, there we have it. We'll move this over here. All right, this is what it says in a standard contract. Everybody's seeing this. It says borrower's right to prepay. I have the right to make payments of principal at any time before they are due. A payment of principal only is known as a prepayment. When I make a prepayment, I will tell the note holder in writing that I am doing so. I may make a full prepayment, that means pay it all off, or partial prepayments without paying any prepayment charge.
This is not contract language that is in a mortgage.
It's
No contract language speaks in the
this is where it came from.
Contract language speaks in the first person like that. This is not contract language that you would find in any standard PNC, Bank of America, Chase.
Do you have a mortgage?
No. Goodbye, sir.
Okay, goodbye. That's exactly where it came from. All right, folks. See, not everybody wants to be taught this. All right. There you go. So, all right. Anyway, let's get this off the screen. So let's get back to what we were talking about. Okay. So we have a $200,000 mortgage. So let me put that on the screen. Okay. So the first thing we're going to talk about, ladies and gentlemen, is what happens when you prepay a loan. All right. So we want to make sure that we are not making ourselves in debt for a long period of time. And the only way to do that is to cancel interest. All right. So here we go. Let us put a $200,000 mortgage on the screen. All right. And share screen. There we go. All right. So we're adding this to the screen, $200,000 at 6%. Okay. When you have a higher interest rate, you have a lower principal payment. Okay. So one of the things that we're going to go over today is what can I do to make sure that I am saving money? What can I do to make sure that I'm saving money? So let's understand prepayment. Okay. So if I prepay If I make my payment, my first payment is $11.99.10. If I make my first payment in January, I just made my payment of $11.99.10. $199 went to principal, $1,000 went to interest. So, but I can look at the amortization schedule and see the principal payment, $200.10. Okay. If I prepay the $200, I do not have to pay the $999 in interest. So if I shoot for or pay for a lower interest rate, if I buy a lower interest rate, let's say I'm not at 6%, let's say I can get this at 4%. Let's put that on the screen. So we're going to do the same mortgage at 4%. We're going to change the interest rate down to 4. There we go. We're going to change the interest rate down to 4. And when we do this, look here. The interest payment, the principal payment is $200.10 on the second payment on this amortization schedule.
Don, none of this is relevant because that's not how the contracts work.
Okay, sir, listen. So if you want to disagree with me, that's okay, but not right now because I'm in the middle of a presentation. Okay.
I know. I'm just saying.
So
I understand the math.
why don't you do this?
appreciate-
Why don't you do this?
Wait,
Write this down. Area code
sure.
256
Okay,
886
okay.
1867. That's my office number.
67.
Okay.
Okay.
256 886 1867. That's my office number.
1867.
Call them
Okay.
right now and say, listen, have Don call me back and then we can have this discussion offline. How's that?
Okay, I understand. I just want to be clear. I understand the mathematics and what you're saying and how they come out to be true.
Mhm.
It's how it's just it's not actionable.
Okay. Well, sir,
Like,
sir, listen, like I
that's my
said, like
point.
I said,
I do understand.
like I
do
said,
understand what you're saying.
I've been doing this for 19 years. So why don't we have the
Right.
discussion offline?
Right.
Okay. And
Right.
and we'll pull up a Zoom, just me and you, and then we'll have at it. But everybody here wants to learn, and you're getting in the way.
Well, I think it's a little bit disingenuous.
Well, that's fine. You can have that discussion offline.
Because what
Okay.
you're
Do you want
saying is-
do you want me to remove you from the room? Because I
Oh,
offered to
no,
give you
sir.
my
No,
time for free.
no. I'm done. I'm just having a conversation.
No, no,
Sorry.
I don't need to have a
No.
conversation right now,
That's
sir.
fine.
Not now.
Argumentative.
Not now.
Okay.
Okay. Because I'm in the middle of a presentation.
I know. I'm not trying to be argumentative.
Then stop
Just-
talking.
Sir, I'm sorry.
Thank you.
Matt, he asked you to be quiet. Just chill.
Okay. I'm sorry.
Okay. All right. So we have a $200,000 mortgage here. All right. At 4%. And when you have it down to 4%, when you lower the interest rate, here's what happens to your payment. Your principal payment goes to $534 here. So now, if I want to get rid of one line on the amortization schedule, then it's going to cost me $534 to get rid of this line instead of $200 to get rid of this line. I need you to take a look at cumulative principal and cumulative interest. Cumulative principal and cumulative interest. If you all want to see these numbers, please go to YouTube so that you can see it. Okay. Let's see. Is this? Yes. Somebody asked me, go to Silverline. You can see all these numbers on YouTube. So that the link is at the top of the page. You can go on, if you want to go on your other phone or your laptop or your, your other device, you can go to YouTube and search P.I.L.L method and you can see these numbers. How's that? Okay. Excellent. So now I need you to see cumulative principal and cumulative interest. All right. If I look at 1 year on this loan, $2,456 and a penny. If I add up all the principal payments for 1 year, it comes to $2,456 and a penny. And how much interest would I pay? I have to add up all the interest payments here. It's $11,993, almost $12,000 in interest. So here's my question. I have to pay, let's put this calculator on the screen. My payment is $1,199.10, $1,199.10 times 12 comes to $14,389.20. When you add these two together, the principal and interest, it comes to $14,398.20. That's how much I have to pay out in 1 year just to pay my loan down by $2,456 because the rest of it went to interest. Let me ask you something. Should it cost me $14,000, everybody? Should I have to pay $14,000 just to pay my loan down by $2,456? What do you guys think? All right. Put it in the chat. All right. If you're watching me online, put it in the comment section. All right. Should it have to cost $14,000 to pay your loan down by $2,456? Because that's exactly what they're doing. So now here's what you could do. All right. And taking a look at this. Okay. All right. Maha Bless says no. Okay. So if I give this money to the bank, all right, if I give this money to the bank, $2,456 up front, will they subtract it from the $200,000 that I owe? Okay, so let me put the $200,000 in here, okay, in my calculator. All right, let's delete this. 200,000. All right, and then we're going to subtract 2456.01. 2456.01. That comes to exactly $197,543.99. That comes exactly to that. So I'm right here. So do I have to pay the 2456 in 12 monthly installments and give them interest every single month? Or if I had it, could I pay the 2456 on line one and be paid down to here in 1 month? Okay. If I do, I skip all the interest payments between line 2 and line 12. That's almost $11,000 in interest savings right there that I never have to pay to accomplish the same goal with the same amount of money. Okay. So now we get to see, hold on for a second. I got a hum. Oh, there it is. The hum's gone. Now 2456 at 6% gets rid of 1 year off this loan if I prepay it. If I look at the 4% loan, okay, if I go to the 4% loan, look at this. It's $200,000, okay, and let me get this out of here, okay. We're going to calculate $200,000 and 4%. The payment is less, okay, but look at the principal payments. They're higher. It starts out at $199 on a 6% loan. All right. See my small principal payments? Look at my principal payments on a 4% loan. Look how much higher they are. $289, $290, $291. So if you add it all up for a year, look here. If I want to take off 1 year, now I have to pay $3,522.04. So everybody, you tell me, will my money go further in killing interest and killing time on the loan if my interest rate is actually higher? You tell me. By lowering the interest rate, I actually make the loan harder to pay off faster and cheaper. And that's one of the things that the financial gurus are talking about. You can buy down the rate, but if you do, it will keep you in debt longer because your principal payments are higher. Now, I'm going to show you one more thing that's going to really make an impact on what we're talking about here. And then we'll move on to the next point. Okay? So let's take a look at this. We are, and anybody who wants to come to the stage, please do and ask questions, because questions make this thing go. All right? Come to the stage and ask questions. So I'm going to put another mortgage on the screen. Okay? We're going to put another one on for $70,000. Now, this is a mortgage back in, let's say, the 70s, $70,000, but at an 18% interest rate. Look at this. This is crazy. Okay? 18% interest. If you all want to see this, please go to YouTube so that you can see it. At 18% interest, look at this. Look at the principal payments now. $4, $5. If I make my very first payment here in January and I prepay February's principal payment only $5.03, I kill payment number 2 and knock off $1,049.93 in interest I never have to pay. Okay? So here's what we need to know. Write this down. Control the principal payment and you control the loan. Interest payments I skip don't matter. Remember this. If you want to get out of debt and you want to optimize interest savings, remember this. If you want to control the loan, control the principal payment. Don't buy down the rate. Okay? If you need a lower payment to make it fit in your budget, then get it. But most people don't need a lower payment when they get their mortgage. They want or would like a lower payment, but they don't know what that means in interest cost overall. Okay? So I can knock this out in 7 years, okay, and save enough interest so that it's like borrowing the money at 0.5% when it's set up like this. Okay. Do you see here? Now I need you to see one last thing. If I add up all the principal payments for 1 year, it comes to $64.67. And then they want me to pay $12,000 in interest. If I prepay the $64.67, will I be down to line 12 on this loan right away? If I give them the $64.67 up front. Do you see what I mean? $64 kills 1 year on this loan because it's at an 18% interest rate. So right now, interest rates are hovering between 7% and 6.5 right now. Don't try to wait to get your mortgage. If you can afford it, get it now, because the houses are only going to get more expensive. Don't wait for the interest rate to come down. Okay? What you want is for you to manage your principal payment so that you can affect interest savings on this loan. So that's number one. So let's go to another example. Do I have any questions about this so far? Put it in the chat. Come up to the stage and ask your question. Ken, why'd you let me not moderate you, man? Why'd you let me get so busy? How you doing today?
Yeah, you was dealing with Max, so I know he was messing with your brain cells.
Well, see, listen, man, not everybody gets this right away because we've never been taught how a loan actually works. And so when you're asked to explain how a mortgage actually works, you think you know, but when you're asked to explain it, if I had done this, it would have only embarrassed him. I would have said, explain to me how a mortgage actually works. He wouldn't have been able to do it because it's not taught at any level of financial education. So, and I didn't.
Well,
go ahead.
You know, we're in a new era where the students come in and they ain't even enrolled in the class, but they come teach the teacher.
Well, that happens a lot. That happens a lot. All right, folks. So what else do we have here? Let me pull up my notes here, and we're going to go right down the list. Okay. We're going to go right down the list. And so I'm going to pull up my notes. And there we go. And no, we don't want that. We don't want that either. This is what we want. Okay. So, all right. So let's talk about biweekly payments now. Okay. Let's talk about biweekly payments and what happens there, because that's the next thing that people do. They want to do biweekly payments. So we're going to take this off the screen. Let's talk about it. Now, anybody here know about biweekly payments? Put it in the chat. Say yes or no if you know about biweekly payments. Yes or no, because that's all I knew years before is how to do a biweekly payment. Let me explain to you what that really is. When you take your mortgage payment and divide it by 2, and you make a payment on the 1st of the month, and then another payment around the 15th of the month, and that's a biweekly payment. Now, let me tell you the results of that. The most you can save on a biweekly program is 4.9 to 7 years on your mortgage. So if you have a 30-year mortgage, the most you're going to save is 7 years. You're going to turn a 30-year mortgage into a 23-year mortgage. But if you use the P.I.L.L method, most of our clients pay off their entire mortgage, their car loans, and their credit cards, and their student loans in about 7 years. Pay off everything in 7 instead of just saving 7. So let's talk about how that works. So when you make your first payment, and I need some answers on this. If you're using a bi-weekly payment system, when you make that first payment, are you saving money? When you make that first half payment on the first, is that saving you any money? What do you guys think? Yes or no?
No.
Exactly. You're not. Do you know why? Why is that, Ken? Why do you know why?
I don't know why, but it's only a half a payment, so I know it ain't taking too much.
Okay, so here's what's happening. When you make that payment on the first, the bank just holds it. They hold it until you make the second payment, and then they apply it, just like you paid the whole thing on the first. That's why you're not saving any money with a biweekly payment when you make a payment on the first and you make a payment on the 15th. Here's how a biweekly payment works. Every 6 months, there's an extra week. So you're going to make a payment in that month. You make a payment on the first, you make a payment on the 15th, and then you make another payment around the 30th of the month. That third payment is the one that saves you interest and it saves you time. That third payment in that month. In 6 more months of biweekly payments, you're going to hit that month where you have an extra week in there, and do it again around the 1st, around the 15th, and around the 30th. So when you add up the 2 half payments, that becomes 1 full payment. That's when you're doing 13 payments a year. That's what a biweekly payment does. It helps you to make 13 payments a year, and you will save a lot of interest. You will pay off in 23 years. But let me ask you, do you want to pay off in 23 years? Or do you want to pay off in 7? All right. So that's what a biweekly payment does. What else can we find out about a biweekly payment? So most companies that do biweekly payments will not do a biweekly payment unless they can draft your bank account for each payment. And a lot of them actually charge you between $1 and $3 every time they draft your account to make a biweekly payment. So what does that mean? They draft you 26 times a year. They're charging you 26 times a year. But out of that 26 times, only 2 of those drafts actually save you money. Why? Do you see what's going on here? The bank is making a ton of money. All right. And what else are they doing? Do you know the real reason? Hey, Ken, do you know the real reason why I think banks came up with biweekly payments? Anybody want to venture a guess? What do you think, Ken?
I don't know why they came up with. I mean, to appease the people, but I don't know.
I'll tell you why. I'll tell you why. Because I never pay my mortgage on the first. Do you? Do you pay your mortgage on the first?
My house paid off, so I don't know.
Okay. So here's what. Well, when you were making a mortgage payment, did they give you 15 days grace period?
Mine was
So you could actually pay it on the 15th.
I didn't have a traditional mortgage. I had a couple land contracts.
I understand. So anybody else have a mortgage in here and know you have a 15-day grace period? Yes or no? Put it in the chat. A 15-day grace period. Okay. So I never pay my mortgage on the first. I pay it on the 15th or the 16th. Yemi says yes. Okay. I pay it on the 15th or the 16th. And do you know there's no fee? Yemi says he pays on the 15th. Why do you do that, Yemi? Can you come to the stage and talk to us? All right. Let's invite him to speak. Okay. Why do you pay on the 15th? Yemi, what's up? Click that microphone in the lower right-hand corner, and then you'll be able to speak.
Hello, can you hear me now?
Yes, sir, I can hear you. Why do you pay on the 15th?
Yeah, welcome everybody. So this is my first time of actually talking here.
Yes.
And, yeah, I'm a real estate agent,
Mm-hmm.
and I just like to play with the numbers, play with whatever is up there for me to grab.
Mm-hmm.
So getting to pay on the 15th at least gives me time to use my money for other stuff.
There you go.
Yeah.
Now, if you pay on the first, now who's using your money?
The bank.
So because more people started paying on the 15th and the 16th, so actually you can go up to the 16th. And because it gives you,
I set up my automatic payment. I actually have one primary residence and 5 investment properties, and all of them are set on the 15th.
there you
So
go.
by tomorrow, is today 15th or yes?
Today's the 14th.
Okay, so by tomorrow, my account is going to get hit by all these mortgages. But at least I get to use my money before they get to take it.
Exactly. And that's the reason why I do it, because it doesn't cost you to do that.
Yeah.
Not at all. All right.
Yeah,
So now if I institute a biweekly payment, at least I get half the money on the first. Correct?
Yes, correct.
Exactly. And that's why I don't do biweekly payments. Okay. So here's the next thing we're going to go to. We're going to talk about refinancing to a lower interest rate. Refinancing to a lower interest rate. I just got a call yesterday from one of my clients that says, I'm being offered an FHA streamline loan. Okay. An FHA streamline. And I said, now, what interest rate do you have? I know what interest rate they have. And says, now, if you could get it, what interest rate would you like? I said, well, I would like to get a 4% interest rate. Okay. So let me put this back on the screen, and I'm going to show you why I never refinance just to get a lower interest rate. I may refi so I can cash out to make other investments. Okay. I may do that, or I may get a HELOC. Okay. If I've got investment properties, I can't get a HELOC, but I can cash out refi, take that cash and deploy it so that I can make down payments on other properties. Now that's a different story, but I never, ever, ever, ever refinance just to get a lower interest rate. And here's why. Let's put it on the screen, ladies and gentlemen. Okay. Now, whatever you do, you don't want to cause, let me put this graphic on the screen. So we're going to put this graphic on the screen. Here's the things that we can do. A 15-year mortgage. I'm going to show that. Biweekly payments. We just talked about that. Large down payments. We're going to go over that again. Okay. I didn't get the chance to get into that because somebody wanted to argue with me. But anyway, we'll do it better. All of these things are put a link in this chain that binds you to your debt for way too long and costs you way too much money. Everything that we're taught to do actually keeps us in debt longer and costs us more money. Okay, so let's take this off. So now let's take a look at what were we doing here? We were looking at refinancing. So I'm going to put in here a $400,000 loan. Okay, 400,000 at 7%. Okay, there we go. 400,000 at 7%. And okay, so 400,000 at 7%. Now, here's what I need people to do. I wish everybody would do this before they refinance their loan. Count up how much interest you've paid, because everybody most people refinance an average of 5 to 7 years. Let's say this person has been in this loan for 7 whole years, 7 years. Okay, so we're going to go down on 400,000 at 7 years. Okay, 60 months is 5 years, 72 is 6 years, 7 years is 84 payments. In 84 months, they paid this loan down by $35,410.30. But look how much interest they paid in 7 years, $188,000. They've already paid $188,000. So this is how much they owe now, $364,589.70. So we're going to copy that. We're going to put it in another amortization schedule. And Yemi, you probably know this to be true, that most people, most of your clients, because you're a real estate agent, if they get a refinance, the bank just gives them a new 30-year loan. Most of your clients that refinance get a new 30-year loan, don't they?
That's true.
Okay. So if I have a 30-year loan and I'm in it for 7 years and I refinance, don't I have a 37-year loan now, Yemi?
Absolutely. 37 years. Yes. and you already paid $100 and something thousand in interest.
Yes, 188,000. So here's now this is what we're going to do now. So we're going to put this in. We're going to put this new number in the amortization schedule. Okay. All right. Let me see if I got it right. All right. We got 7%. Okay. And we got another one. All right. Now, the person told me if I could get 4%, I would really be happy. Right. So we're going to put in the new number, $364,000. Now, when you lower the interest rate on getting your refinance, folks, the interest rate is not the driving force that lowers your payment that much. The real driving force is dividing your payment by a new 360 months. But there is some interest savings per payment if you go down to 4%. Now, they're not going to get 4, but I asked them what would be their dream interest rate. They said 4%. So let's put it at 4%. Here's our new payment. Okay. Oh, I can't calculate the payment yet, Yemi. You know why? I forgot something very important. Closing costs.
Yes, closing costs. Yes.
Okay. So on a refinance, do they ever ask you to pay the closing costs up front?
They build it into the loan.
They build it into the loan. So would it be fair to use a $10,000 closing cost on a refinance?
Yeah, on a $400,000 property, that's pretty much realistic.
Okay. So we're going to say, so I have 364,000. So now it's 374,000 at 4%. And I just only raised the payment by, about $25 by rolling that in. Now, here's what you're told, ladies and gentlemen. You're told this. You can figure out if it's worth it to you by taking your payment savings and dividing it into the $10,000. That will tell you how long you need to be in the loan to recoup your money. Is that true, Yemi?
Yes.
Okay. That's exactly what they want you to think. That's exactly what they want you to think. But I'm going to show you what's really going on with this loan. So first of all, we're going to put a calculator on the screen. Okay. We're going to take a look at our payment savings. Okay. Our old payment used to be 2661.21. Okay. 2661.21. Our new payment is 1788. Okay. Minus 1788.35. Okay, that's a difference of $872. That's quite a bit. So if we take our $872, okay, and divide it 872, I got to write this down, 872.86. So we're going to take that and put in our $10,000. That's our closing cost. $10,000 divided by 872.86 equals 11.45, 11 and a half. Let's just call it 11. It's going to take you have to be in this loan 11 months, okay, to recoup because of the $800 in savings. That's what they're teaching. But let me tell you what's really going on. So Yemi, I need your help here. On this 4% loan, okay, my payment is the 17. Okay, my payment, let me get rid of this. Okay, my payment is 1788.35. Okay, 1788.35. So here is my interest payments adding up. Okay, all my interest payments. Here are my principal payments, $539.72. All right. So now if I borrow $10,000, when I add that $10,000 to my loan, it's a loan within the loan. So I'm actually borrowing $10,000 to pay my closing costs, but I'm adding it to the loan. But I think it's at 4%. That's what I'm thinking anyway. But if I look at how much principal I paid down in 1 year, Yemi, can you see my screen at all? You'd have to be on YouTube to see it. Okay. And
I'm just following. I'm not
that's okay.
on YouTube right now.
That's okay. All right. So in 1 year, I'll tell you, you pay this loan down by $6,596.86. $6,500. We haven't even paid back the $10,000 yet, have we?
No.
No. Do you know how much interest you pay on that? $14,863.
On that 10,000 alone.
No, just on $6,500 of it.
Crazy.
In the first year, you just paid down $6,500, and the interest cost is already at $14,863 on top of the $188,000 you've already paid before you refinance. Now, here's how long it takes to pay back $10,000. It takes 18 months to pay back $10,000 in principal. You get to $9,995.13. That's the principal pay down. And it costs $22,000 in interest to pay back $10,000 on your loan to get back to your original $300,000 $64,000. So,
That sounds like extortion.
so your real cost on this refinance is $32,000 in the first 18 months. What do you think, Yemi?
That's a total ripoff.
So let me ask you this. If I lend you $10, everybody, if I lend you $10, Yemi, and I said, okay, pay me back tomorrow, but when you pay me my $10, give me $10 on top of that, $10 interest. What interest rate is that?
I'll say that's 100%.
100%. Do you want to pay 100% interest on anything?
No.
All right. So let me ask you, if I borrow $10,000 to pay my closing costs and I pay back the $10,000, but I paid $10,000 in interest, isn't that 100% interest?
Yeah, 100,000. Yeah.
Oh, but what if it's $22,000 in interest? Isn't that 200% interest?
100%. Yeah.
Everybody, even people with perfect credit, are fooled into making these kinds of moves on their mortgage. And it makes them think, because they get a lower payment, it makes them think they're making headway when they're really not. Plus, it increases your principal payment. And anytime you increase your principal payment, ladies and gentlemen, it makes it harder to pay the loan off faster. Okay? Because we were at, on the other loan, because we start out here at 571. Let's see where we were on, okay, at 84 months. We were at 531. So a smaller principal payment would actually get rid of one line of debt. But if I go to 570, now I have to come up with more money to get rid of interest and payments. I make it harder when I lower the interest rate. I hope that makes sense. So I'm actually forging a link in that chain. So, Yemi, you want to talk? Let's talk about how to manipulate our terms. Okay. So we're going to use the same loan. We're going to use the same loan and put it in at a 30-year mortgage. And we're going to put it in as a 20-year mortgage. And we're going to put it in as a 15-year mortgage. Okay. So do some of your clients opt for, they say, I want a 15-year mortgage, I don't want a 30?
Most of my clients go for a 30-year mortgage.
Okay, but have you had some that wanted a 30-year? I mean, a 15-year.
Yeah, definitely. I've had some of them want a 15-year, but they just don't qualify for it.
Okay.
Maybe due to their income and stuff like that.
All right. Well, now you can tell them, be glad you didn't qualify for the 15-year. Okay. So let's do this. All right. So we're seeing, let me get rid of this one. All right. We got a $400,000 mortgage at 7%. Okay. We're going to put in, for 30 years, we're going to put in another one at 7%. Okay. And this one is going to be 240 months. That's a 20-year loan. Okay. 20 years. And we're going to do one more at 15 years. Okay. 7% at, I got the wrong numbers here. Hold on. I got to go back. Okay. 400,000. I need 400,000 here because I changed the numbers. Hold on. Okay. At 7%. There we go. 20 years. All right. And then we're going to duplicate that. All right. And let's see here. 100,000, 240 months. There we go. And now we're going to duplicate this one. All right. And then we're going to put in 180 payments for 15 years. Now I'm going to compare all three of these. Here it is at 30 years. Here it is at 20 years. Here it is at 15 years. All right. Here's our payment. At 15 years, the payment is $3,595. At 20 years, it's $3,101. At 30 years is $2,661. All right. Now, I need you to take a look at how this payment breaks down. And Yemi, on the 30-year loan, the very first interest payment is $2,333.33. On the 20-year loan, and you can do this on your own, Yemi, when you get a chance. On the 20-year loan, the first interest payment is $2,333.33. On the 15-year loan, okay, on the 15-year loan, the very first interest payment is $2,333.33. Yemi, did you know that to be true?
I never knew that.
Listen, I need you to write these down, and I need you to pull out your calculator and take a look at this. Okay. So now let's take a look at what's really going on here. I'm going to go back over all three loans. Going to go back over all three. Okay. 400,000. Okay. 20. There we go. All right. Let's take a look at how much interest. If we just make the minimum payment, Yemi, we make the minimum payment on the 30-year loan for 1 year. We're going to pay $27,871 in interest. That is on the 30-year loan. How much interest do we pay on this loan if it's a 20-year loan? So we got $27,871 on the 20-year loan. Okay, is $27,698. It's almost as much. In the first year, you're going to pay almost as much interest. That is on the 20-year loan. On the 30-year loan, I'm sorry, the 15-year loan, $27,504. We're still in the $27,000 range on the 30, the 20, and the 15.
Yeah.
So why do people do this?
So
Because
they're really not saving anything.
no, man. In fact, they make it harder. So here's Yemi.
On top of that, they're paying a higher mortgage payment.
Exactly. So listen, folks, you don't need permission to have a 30-year loan. You don't need you don't need permission to have a 15-year loan. If you don't know anything about the P.I.L. method, if you do not want to engage with our opportunity cost calculator to optimally save interest, you don't need to do any of that. Okay. If all you want to do is have a 15-year loan, get a dime store calculator or go to online. And because I use Brett Whistle, but you can go to any online thing that does a mortgage calculations for you. Find out what the 15-year payment would be and make it. You get a 30-year loan and just make the 15-year payment. Anything wrong with that, Yemi?
No.
But if things get tight,
You can always pay your regular payment.
you can always go back to your regular payment. But if you get that 15-year mortgage and things get tight, baby, you're stuck with that $3,000 payment.
Absolutely.
Yeah, I never, ever, 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 ever. There's absolutely no financial benefit at all to get a 15-year payment if you understand how to read an amortization schedule. But I tell you this, folks, if I want to make all 180 payments and I don't know anything else, I'll get a 15-year if I want to make all 180 payments. But my clients pay off in about 7 years. Okay, that's 84 payments. And they're done. It is easier. It is easier. And I'm going to show you here at the 30 on the 30-year payment, my principal payments are in the $300 range. So if I prepay $329.79 on line 2, I knock off the interest on line 2 of $23.31. On the 20-year loan on line 2, I have to come up with $772.35 to kill $2,300 worth of interest. On the 15-year loan, I have to come up with $1,269.34 prepaid to kill a $2,300 interest payment. Folks, by prepaying, by lowering the term, am I making it harder to pay the loan off cheaper and faster? What do you guys think? Okay. So, folks, if you lower the term, if you lower the interest rate, all we're doing is this. We just put another link in this chain to keep us in debt longer than we should be and pay more interest than we should. Keep this in mind. Get a 30-year loan and pay it off in 7. Don't buy down the rate. And do not refinance to a lower rate. Okay, we've covered that. What else do we have? Okay, we have the debt snowball, the avalanche method. We have rounding up the payments. Okay, so let me get into this. Let's go. So the avalanche method to pay down the debt is with the average family has 13 different debts. Okay, and if you start with the avalanche method, says start with the debt that has the highest interest rate and pay off the debt down to the one that has the lowest interest rate. Okay. Now, you tell me, Yemi, in your experience, are credit card interest rates higher than mortgage interest rates?
Yeah, I'll say credit card payments are higher.
Okay. Credit card interest rates are higher than mortgage interest. So give me an undesirable credit card interest rate.
29.9.
29.9. Okay. So let's go ahead and do that. All right. We're going to put in, okay.
I'm going to be mute for a while,
Okay.
but I'm listening.
All right. That's quite all right. But thank you for your participation. I appreciate it. Okay.
Thank you.
All right. So we're going to put in, let me get rid of some of these so I don't get confused. All right. So we're going to put in a credit card. Let's see, Brett Whistle. All right, there we go. We're going to put it in a $10,000 credit card at 29.9. Okay. When you put it into an amortization schedule like this, you need to change the number of payments to 240. There we have it. And we're going to calculate that. Now, everybody in here, if you have $10,000 on your credit card at 29.9%, what are all the experts telling you? What are all the financial experts telling you? Dave Ramsey, Susie Orman, anybody else online? What are they saying about this $10,000 card at 29%? Are they telling you to pay that off? Put it in the chat, everybody. Put it in the chat if they're telling you to pay that off. Is that what you're learning? All right. So I got to get this off my screen. Hold on. Okay, there we go. Okay. Now, I need you all to see this. How much interest are we paying on a $10,000 card at 29.9%? The amount of interest the very first month is $249.17. That's it. $249.17. Now, let me ask you, everybody, if I get a credit card and I have $10,000 on it, I just charged $10,000, but I pay it off before the bill comes, will I owe any interest? Yes or no? Put it in the chat. Will I owe any interest? No. Okay. I won't owe any interest. So, all right. Yemi says no. All right. But that means I will save $249.85 in interest I don't have to pay. Okay. Now, let me show you something here. Okay. So this is debt snowball theory and avalanche theory combined. Okay. Paying off a smaller amount, which was $10,000, which is less than my $400,000 mortgage. So it wants me to focus there. Okay. Exclusively. And I'm killing something that has a higher interest rate than my 7% mortgage. I'm made to feel as if the 29% is higher somehow when all the interest is $249.85. But the first interest payment on this mortgage at 7% is $2,333.33. You see, folks, what I'm talking about is interest consumption. How much interest are you consuming each and every month? We are taught to ignore how much interest we're paying, so we're not looking at it. So it feels as if the credit card at $10,000 at 29.9 is costing us more than our mortgage at 7% because we're not doing the math and we're not looking at the numbers. It's called inattentional blindness. We're blind to what we don't pay attention to. We're blind to what we don't pay attention to. So somebody can come along and tell us, get rid of that card. It's costing you too much money. So watch this. Here's my choice, ladies and gentlemen. If I have $10,000 in the bank, I could pay off the credit card and be done and save my $249.85. Or I could say, you know what, Visa, I'm going to just give you the minimum payment this month. This month, I'm going to give you the minimum payment. I'm going to take my $10,000 I could have paid you off with and put it on my mortgage at 7%. Let me show you what $10,000 does to this loan. It knocks off 2 years and 1, 2, 3, 4, 5. It knocks off 29 months worth of payments, 2 years and 5 months worth of payments. And it saves me $66,000 in interest I never have to pay. So I'm going to take Visa's money, put it on my mortgage and save 66 grand. But if I take Visa's money and pay Visa back, I save a grand total of $249. Do you see what I'm talking about, folks? What they're teaching us does this. It keeps us in debt longer because that's another link in the chain when we focus on interest rate instead of interest cost. Stop building chains around yourself and keeping you in debt longer by doing this. Now, here is a big one that everybody's talking about because now I'm getting towards the end of my show. I've been here an hour and 23 minutes. A big one. And we started out the show with this, but I couldn't finish because we had somebody who didn't quite understand how mortgages work, and that's understandable. But instead of being taught, they wanted to talk and teach me. Okay? So here we are. All right. Let me hold on for a second. My assistant is trying to get a hold of me. All right. Okay. My assistant, watch this. My assistant Teresa is going to her children's school. Okay. Her daughter's school for an award ceremony. And I'm just going to tell her, send me pictures. Hold on. All right, send me pictures. And I just and let me and I just told everybody online that I did this. She says I do too much. Oh boy. So she's gonna send me pictures so I can see the kids. I'd like to pretend that her kids are my niece and nephew. All right. So anyway, so let's talk about doing large down payments on a mortgage. Okay. Never, ever, ever, ever do it. Don't do it, ladies and gentlemen. And this was probably going to be my last example today about how we are building chains that bind us by doing what the experts are telling us that keeps us in debt longer. So let's recap. Okay. We don't want to do biweekly payments. We can pay the loan off in 7 instead of saving 7. All right. We don't want to refinance even the FHA streamline loan. We don't want to refinance just to get a lower interest rate. It makes it harder to pay the loan off faster, and it costs us way too much money. Refinancing to a lower interest rate does not save us money. Okay. Never buy down the rate. Okay. I just showed that by getting a lower interest rate off the bat, your principal payment is higher instead of using a lower principal payment to attack the loan. Remember this. Control the principal payment and you control the loan. Interest payments I skip by prepaying don't matter. Okay. Remember that. So what else do we have? We have don't shorten the term. Never get a 15-year mortgage. Never get a 20-year mortgage. Always get a 30. Now, I'm going to tell you, some of you have had your loans modified. And without you knowing it, some of you were put into a 40-year mortgage when you got that modification. If you're in a 40-year mortgage, if you've had a modification, you need to call me today at 256-886-1867. Or, okay, it's crawling across the screen, or contact me at ice10k.com. But there's my number, 256-886-1867. All right. If you had your loan modified, call me because you're probably in a 40-year mortgage. And I'm telling you right now, if that's the case, you are blessed. I'm going to show you how that 40-year mortgage is actually helping you. Okay. All right. So let's see here. And now I'm going to come back. I'm going to take a quick break. All right. I want you to listen to somebody who is actually, we're going to play a little video, and let's listen to some people who have actually used our program and done well. All right. Listen to this. How many want to know how to pay off all of your debt in an average of 7 to 9 years? You can do all of this without refinancing, without change to your budget, without sacrificing lifestyle.
Me and my husband do the P.I.L.L method, and last year we were able to pay down $33,000 on our mortgage without feeling like we were poor. We still did tons of entertaining things and enjoyed our family.
You don't have to eat beans and rice every day. You don't have to cut up your credit cards. You don't have to drive a 30-year-old car. You don't have to sell pizzas at night to pay off your mortgage. All you need to do is pay the bank less interest. That's what we're talking about today. Here is what P.I.L.L method stands for: prepayment of principal, isolation of principal amounts, leverage, and liquidity. You understand it? You have a way of getting out of debt more efficiently. The interest rate you're quoted is not the interest rate you pay. You think you're buying a $500,000 home. The true cost of that home is what? $758,000. Total interest paid as a percentage of principal, 51.777%. That's what's going on with this loan. The ability to read
and defeat an amortization schedule is not taught at any level of financial education. I need you to understand the power of a penny. You will not hear what I'm talking about from Dave Ramsey. Do you know why? Because I own the copyright. I literally wrote the book.
But Don has some valuable information that can contribute to the quality of a person's life. And it only costs you a few dollars. It's his book. Why not get that?
I'm going to go through the P.I.L. method myself with some of my investment properties. So I'm going to link up with Don, and then I'm going to sit down with him, show him my investment portfolio, and see how I can eliminate interest.
All right, ladies and gentlemen, we're back. All right, so if you want to know more about this, go to ice10k.com. Let me put that banner on the screen for you. ice10k.com. All right, where is it? All right, ice10k.com. All right, and get a savings and earnings report today, okay? Go to ice10k.com and get a savings and earnings report. And we will not charge you for that. You can know the month, day, and year you could be debt-free and how much interest you could save. All right, do it today. Don't hesitate. All right, stop letting the bank do this to you, giving you false information, thinking that you're doing the right thing when in actuality, you are building chains around you, keeping you in debt longer, costing you more money. Okay, so let's do this. Let's talk. Let's put this on the screen. So we're talking about large down payments now. Large down payments. Okay. Anybody else who wants to come to the stage and ask questions, please do. All right. So we're looking at a $400,000 mortgage at 7%. Okay. We're looking at also putting $100,000 down. Okay. So we're going to end up with a $300,000 mortgage. Now, what are some of the reasons why we would do this? Okay. So that we could, on our conventional mortgage, so that we could eliminate, PMI. All right. How many of you would love to eliminate PMI? All right. So they put $100,000 down to eliminate PMI. But here's what we're talking about. If we do this, okay. All right. 300,000. My payment is $1995.91 versus $2661. Okay. But on my $400,000 loan. Okay. Something happened to my screen. Hold on for a second. I got to put it back on there. Okay. All right. And let me see here. Present, share screen. And there it is. Okay. All right. And add it to the stage. There we go. All right. So our principal payment is $327.88 on this. $327.88. All right. So if I want to start here on payment number, if I have my $300,000 mortgage, okay. Now my principal payment is smaller. That's good. All right. My principal payment is smaller. That's a good thing. But I put $100,000 down. But what is going to be the real savings here? What's the real savings? Let's take a look at the summary. The amount of interest that the bank wants me to pay over 30 years is $558,000. $558,000. Okay, there we go. So let's take a look at that. We're going to put it in our calculator. $558,000. $558,035 and 60 cents. Don't forget the 60 cents. The bank wants that. Now, if I put $100,000 down, now the bank wants $418,000 in interest. So we're going to subtract that. 418,000. Okay. 418,527 and 60 cents equals $139,000. Okay. That's how much I'm saving if I keep the loan for 30 years. 139,000. But if I get the $400,000 loan, okay, I still have my $100,000 and I have PMI. But if all I know is I was going to put the $100,000 down and I'm not using the P.I.L.L method, I still have $100,000. What if I take my $100,000 and prepay it to principal instead? Let me show you what happens. We're going to take a look at cumulative principal here and add it all up at one time. Cumulative principal, and scroll down to $100,000. Here we go. Right here. And knock off 176 payments we never have to make. How much interest have we saved already in just 1 month? $368,000. And the only problem is I had to pay PMI for 1 month. Now I can apply to get my PMI taken off, but I'm still at a $300,000 loan, but I don't have it for 30 years. Okay. I've knocked off almost 15 years off this loan. I've got 14 years off the loan in 1 month by putting the $100,000 down. So folks, let me tell you this. Do not continue to let the banking system or so-called financial gurus keep you in debt. Okay. Here's one of them.
Good.
So I am.
Yeah. Don't let them keep you in debt forever by giving you bad information. Okay. Here, don't 15-year mortgages, snowball method, biweekly payments, large down payments, all of that binds you. The way to get out of debt is maximum interest canceled. And the way to do that, to cancel interest, is to use AI. We have the only AI system, we call it the opportunity cost calculator. We have the only one that tells you exactly how much money to pay, what month to pay it in, what day of the month to pay it on, and which loan to attack to optimize your interest savings. Okay, so let me get this off the screen. Anyway, folks, I hope this has been educational for you. I hope this has been helpful. All the things that we've ever been told, read the description on this YouTube video. And when you read the description, it gets into more detail of the very things that we've been taught to do to get us out of debt faster, actually keep us in debt longer than if we learned interest cancellation. So all of the things that they're teaching us, forget it. Understand controlling your interest cost, because that is the cause of long-term debt. I need you to think about this for a minute. Stop treating the symptoms and treat the cause. What keeps you in debt longer? The interest. Let me ask you, if all of your debt was 0% interest, is there any financial benefit to paying the loans off early? I know it's no, there's no financial benefit to it. So why does every program out there talk about paying off the principal and how fast you can pay off the principal, and they don't pay any attention at all to how much interest you're paying along the way? Pay less, pay less interest, get out of debt faster. Pay more interest, stay in debt longer. So the way to manage your debt is to kill the maximum amount of interest that's mathematically possible for you. And you can do that with your current budget without having to make more money. And you can save more money towards retirement along the way. You can pay off all of your debt in an average of 7 to 9 years. 7 to 9 years, not 30 years to never. And do it with your current budget. You don't need more money to get out of debt, folks. You just need to pay less interest. And you can do this, and along the way, put more money towards retirement at the same time. So, folks, that's it for today. I've been here an hour and 40 minutes. We got to get out of Dodge. So, and let me see if there are any other questions. I don't see that. Thank you, Kim, for putting the ICE 10K in. So go to ice10k.com, get your savings and earnings report today. And next week, let's see, will we be back next week? Let me take a look at my calendar because we're going to be out of town. No, we're going to be out of town on the weekend. I should be back. I'll be back next week to do this all over again. All right, right here. And I'm switching to a Monday show. So you want to go to, and I will give you more information about that, but look for P.I.L.L Method on Monday nights. Okay. On Monday nights, we're going to be doing a Monday show, and live on Wednesdays. We're still going to be doing Wednesday mornings, but people have talked about doing a nighttime show. So we're going to be doing a nighttime show on Monday. We have one last thing to play for you. One last thing to play for you before we get out of here. Let's listen to what E.T. has to say, Dr. Eric Thomas, about the P.I.L.L Method.
Listen to me, y'all. But one of his mentees took us through one of their programs, and I paid off my mortgage. But guess what happened? My marriage went to a whole nother level. And you know why? Because my wife is a security freak. And even when I blew up, my wife would be like, oh, you blew up, but how long is you gonna keep making this kind of money? I was like, I don't know, forever. She's like, you sure? Because I'm gonna keep my license as a nurse just in case you don't. So when I paid the house off, my boy was like, you ain't gotta do that, you can do this. But when I paid the house off using that program, it took the stress level all the way down for my wife because we no longer had a mortgage. Does that make sense? That thing that was coming every month, that was getting on her nerves, we didn't have that no more. And so she was at rest.
All right, folks, you heard it from Mr. E.T., Eric Thomas himself, the hip hop preacher. He used the P.I.L.L Method to pay off his mortgage a lot earlier and saved a ton of money in interest. So if you want to save some interest, do any other program out there. But if you want to save the maximum amount of interest that's mathematically possible, and I'm talking about cutting your interest cost by about 80%, then the P.I.L.L Method is the only way to go for that. I will see you next week. Thank you very much, everybody. We'll see you now.